In this video we'll be talking about the capital gains and losses of both capital assets and ordinary income producing assets. You'll recall that the basis of property is what was given up to acquire the property, such as any services that were provided, any cash or property that was given in the exchange, any debt that might have been assumed by the buyer is compensation and adds to the basis of the property. Any assets that were transferred by inheritance are valued at the fair market value, either at the date of the death or at some alternative valuation date up to 6 months later. So when you sell an asset, the adjusted basis, that is to say the original basis, for example, less any depreciation, is compared to the selling price. And if the proceeds from the selling price are greater than the adjusted basis, a gain results. If the opposite is true, then there is a loss, of course. When we use property, it's the use of that property that prevails in how we handle it for tax purposes, not the asset form or the type of asset. So if you have an automobile and you use that automobile strictly for personal purposes, well, then that asset is not depreciable and is not considered an ordinary income producing asset. However, if that same vehicle is used in your business, then that asset is a depreciable asset. And so same car but used for different purposes determines how we handle it for tax purposes. And we report the sale of these business assets on Form 4797, or if they're capital gains assets such as investment like stocks and bonds, those gains and losses are reported on Schedule D. And we'd use Form 8949 to record these transactions. So the difference then between an ordinary asset and a capital asset, the ordinary asset, as I mentioned earlier, is income producing assets such as inventory and accounts receivable. Capital assets, these are assets that are held for personal purposes, and we call those Section 1221 assets. So these 1231 are business assets, may be depreciable, such as a piece of machinery in the business, or non-depreciable, such as inventory. However, to qualify for the preferential tax rates, which we'll talk about shortly, these assets, business assets or 1231 assets, must be held longer than a year. However, if the asset is disposed of within a year of acquiring the asset, it is then taxed at the ordinary tax rates. And these marginal tax rates are often higher, usually higher than the capital gains rates, those preferential rates. I mentioned earlier business inventory, accounts receivable are good examples of ordinary income assets. And I mentioned earlier again that these assets, if they're held less than a year, are taxed at the ordinary tax rates, and losses are fully deductible. Capital assets, these are assets, they must be held for more than a year, and you remember these are non-business assets such as investments. Some exceptions, however, to this holding period. A property received through a gift or non-taxable exchange generally has a holding period of the transferor, so you really step into the shoes of the giver of the gift, the donor of the gift, for example, and then you'll take their holding period. So if they held it for a year before you acquired it, then your basis would start, your basis holding period would be 1 year at the date of receiving the gift. I think this is kind of interesting that if you inherit property, however, it's always considered long-term property. So if you inherit property in January and sell it in July, you get the benefit of the long-term capital gain rates against any gain you might realize. And these are those long-term capital gain rates. We call these preferential gain rates. So for example, if a taxpayer is in the 10 or 15% marginal tax bracket, they would pay 0% on capital gains rates. If they're above 15% but below 39.6% marginal tax rates, then they would only pay 15% on these capital gains sales. And if they are in the 39.6% marginal tax bracket, then they would pay 20% on any capital gains. The rate is 25% of depreciable property if it's used in a trade or business. And I'll talk more about 1250 property shortly. And then if you sell and make a gain on any collectibles or these preferential qualified small business stock 1202, then you're taxed at 28% on those gains. So the calculation is you net short-term gains and losses together, do the same for long-term gains and losses. If the result after all of these nettings together of gains and losses results, for example, in a short-term capital gain, then that short-term capital gain is taxed at your ordinary or marginal tax rates. If, however, the results of netting all these gains and losses together results in a net long-term capital gain, then that gain is taxed at those preferential tax rates. So as we mentioned, 1231 assets must be held longer than a year to get the preferential tax rates. The netting of the sale of these 1231 assets are similar to capital assets. However, unlike the capital assets, these business 1231 assets may be subject to recapture, and this applies to the depreciation taken in prior years. So, and I can demonstrate this on a subsequent video, but the way this recapture works is this is saying, the IRS is saying, look, if you had the benefit of accelerated depreciation of this asset and then you sold it before the asset was fully depreciated, for example, then we're going to have to have you pay taxes on that gain, and the way to calculate that amount recaptured is to take the realized gain on the sale and then compare it or net it against any depreciation taken so far at the point up to the point of sale. And the difference between those two is the gain that's subject to recapture. And as it says, these recapture rules generally then transform some of this gain, and I just went through that calculation, some of this gain into ordinary gains. So these 1231, as I said, these gains, they do receive the preferential tax rate. However, for individuals, our limit is $3,000 per year. So if we individuals own a business, a non-C Corp business, the losses are ordinary, but the gains can only, so these losses then can be offset and these business losses then are treated as ordinary losses, and we can deduct them on our tax return up to $3,000 per year. Section 1245, business property. These are assets such as equipment that are used in a business. And as I mentioned earlier, the tax rate to recapture the depreciation is taxed at the ordinary tax rates. So as we said, if you have a realized gain and after you've netted any previously taken depreciation, any gain that's left is subject to taxation at the regular or ordinary tax rates. And then the rest of the gain, of course, would be taxed at the preferential tax rates. $1250, this is a subset or a type of 1231 property, and this relates to real estate. For example, residential or non-residential or commercial. Now the capital gain attributable to these types of depreciation on real estate is 25%. And that's of course up to the amount of the depreciation not unrecaptured. And remaining gain is, if any, would be taxed at the preferential or the lower tax rates. So again, with real estate, similar situation on recapture, but here, instead of being taxed at the ordinary tax rates for the amount of recapture, you're taxed at 25% only. And so this is an exception for the recapture of real estate property, any gains. And the reason they do this is because the preferential tax treatment for real estate is pretty limited, since real estate is depreciated on a straight line basis. Personal property, such as equipment, or we call it personalty, this type of equipment gets the benefit of accelerated depreciation. So any recaptured amount of gain on the sale of those assets is taxed at the ordinary tax rate. So they don't get the benefit of this 25% rate. So if we sell stock as a block, then we have one of two options. We can value it using specific identification. That is to say, we can take the specific stock that were sold, compare it to the compare the basis to the sale price, and that is the amount of the cap gain or capital gain that we would tax. All right, so mutual funds. If you sell shares, for example, of funds of stock held in a portfolio, then generally the investment company would send a 1099 div-div. This form will tell you how much in capital gains you realized during the year, any dividends you received, or any distributions that were made from the fund to you. Those capital gain distributions then are recorded on Schedule D. Any sale of assets that you received as a gift, there are some special rules that apply. If the adjusted basis at the time of the gift is greater than the fair market value, then if you had a gain, you'd use the donor's adjusted basis. If you had a loss, you'd use the fair market value. If your gain was somewhere in between, that is to say what you sold it for is somewhere in between the basis at the time you acquired it or the fair market value, you'd record no gain or loss. Beneficiaries of property, for example, we know, as we said earlier, that we value these assets inherited at fair market value. And the holding period, as we said, is always considered long-term. So if you had property with a basis of $3,000, you sold it only 6 months later for $4,000, that $1,000 gain is considered long-term and therefore qualifies for the preferential tax treatment. If you have any questions on this or any other chapter videos, please let me know.